Like, let's just get back to the core of what we wanted, the core principles of, what Satoshi wrote about. And honestly, you and I cut our teeth in this industry really in DeFi. And that was what got us really excited about how that DeFi could change the way financial markets worked. And that continues to be the best use case. And
totally.
That is what I continue to be excited about alongside everything that goes in with that transfer of value.
This episode is brought to you by Geodnet, the world's largest decentralized RTK network delivering real-time, centimeter-accurate positioning around the globe. You'll hear more about them later in the episode. Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed.
Welcome back, everyone, for another segment of the Roundup. We are joined now, exclusive, with Rob, who's taking over Jano's seat. I think
Jano's replacement.
Permanently. Pretty much, yeah.
No, I could never replace him.
How's it going, Rob? How are you doing?
Good. I'm excited to be here. I am on the back of a weekend with beautiful weather in Cannes, and now back in New York where it is hot but less beautiful, but excited to be here.
There you go. So Rob, you've been on the road for like 4 weeks. It sounds like you are now the stablecoin person. So I feel like you're going around all of these conferences talking about stablecoins. And look, you and I were talking about this earlier in Cannes where we met up. It feels like it's moving much, much faster. So why don't we start there? Like of course, I'm wearing the proof of attendance for ECC. I'm coming back. But tell us, like, what is the sentiment in the room? I mean, you were at Goldman's conference a couple of weeks ago. You're at ECC. What's some insights there? We'd love to start there.
Yeah. So if you're thinking about stablecoin specifically, I will tell you at Goldman's event. So this was last week. I think it was last Wednesday. I spoke on the first panel of the day. It's just, Goldman clients primarily, and it was standing room only. And I've been to this Goldman Sachs, digital assets event 3 years in a row. And this was by far and away the most well attended. And so you look around, there's 400 people, family offices, trading firms, like big asset managers. And they really only want to talk about a few things, of which number one was Circle and stablecoins. It's like very clear that this has caught it's in the zeitgeist right now. It is in everybody's mind and really at the forefront of how they're thinking about the future of this space and the thing they want to put money into. It's not surprising to me considering how Circle how well it has done in the public markets. But then maybe what has been surprising to me, to your point, is just how quickly we're seeing like the banks move, just how quickly we're hearing large corporates talk about wanting to be involved or using stable coins and how they think they can do call it cross-border like global money market movement. That has been, I think, the real surprise to me, because these are places that typically do not move quickly. Now, all of a sudden, they're all looking around and they're saying like, oh shit, like I need to get on top of this. And in fact, I was talking to someone at Goldman and they were saying the exec committee is now asking us, like, are we deep enough, right? Like this has gotten to the very top of Goldman and they're saying, do we know enough? And are we playing in this space enough to be effective in stablecoins? And that's what's happening everywhere. And so it's really the topic du jour.
I guess this is not new. You guys have been investing in stablecoins for a number of years. Anyone that's been in crypto has used stablecoins. It's sort of like you stop using wire transfer, you fund most of your deals in stablecoins. What's changed? Like for anyone that's just kind of waking up and like, stablecoins have been around for a while. What was the inflection point? Are there one or two catalysts? What would you point that to?
It was Stripe. I think we all owe Stripe like a debt of gratitude a little bit. No, but even more seriously than that, 18 months ago, I would say, and I see all these companies, to your point, we've been investing for a long time. So I've talked to a lot of people. 18 months ago, if you went and looked at stablecoin volumes and you had a good insight into what was happening, it was basically all trading activity. Now, it is still by far and away the majority of trading activity, but I can tell you for a fact today that there are hundreds of billions of dollars worth of actual economic activity happening in stablecoins at businesses every month. Right. And so, not 100 billion every month, hundreds of billions annually. And it is growing every month. And we're starting to see, everything from payouts and pay-ins to, simply like trade finance and just like global like treasury movements as well. we're starting to see a real excitement about the future of programmable money. That's what's changed. And that is on the back of Stripe going in and telling everybody this is real, and everyone looking around and be like, oh man, Stripe's the best payments business that exists in the world. So maybe we should, take a look at this. Maybe we should do this too.
Yeah, I mean, certainly, like when Stripe acquired Bridge for $1 billion, to me, it felt like the Facebook Instagram acquisition. Stripe has just so much distribution, it's so embedded in so many businesses, and so when you try to like really push this to enterprise, to your point, like it's going to get adopted much faster. And then, of course, they've extended that vision now, acquiring Privy. How, when you talk to enterprises, do you get a sense that they really truly understand how this is going to be used and embedded in their workflow? Or is it just a directive, like people looking at Circle, trading at where it's trading at and the multiple it's trading at, and it's sort of like, let's scramble to get our act together? Or do you find that enterprises have been thinking about it, are thoughtful? Is there a coherent strategy in these organizations to like embed stablecoins?
So it really depends. I think some people are really thoughtful. They've been working on it for a long time. I will tell you, some of these things that are happening though are like complete nonsense. They're just headlines. And I think broadly, so the crypto market, or if you're on crypto Twitter, people see a headline and they're like, this is awesome. And this company with distribution and these customers, they're going to do stablecoins. And then you go and talk to that person, or you think about, what that person does, and they have absolutely no capability to go and actually transact or to build a business that transacts with stablecoins. And so I'd actually put, and maybe I'll get a little bit of hate about this, but I'd actually put this like Fiserv headline out there. Like, okay, Fiserv's going to issue their own stablecoin, and they're going to distribute through all these community banks, and they're going to do it with Solana. And for a day, everybody was tweeting like, oh, this is like a game changer. And if you actually take a step back and you think about, okay, like what is Fiserv? Like they're an old school processor and banking core provider, and their banking core like falls over all the fucking time. It is terrible, cloud native tech stack. The community banks themselves have no ability to actually transact in a 24/7 market with programmability in the transactions themselves. Like there's no way that these community banks and Fiserv go and build a big stablecoin specific, linked to business. What will happen instead is that some startup will come and replace them. And that is what we're going to see. And so everybody's like, acting like there's going to be all of this inflow from these businesses, which I think is trying to happen. But what I expect instead is they're just going to be a replacement of a lot of those businesses. And that's where I think the real kind of like tailwind and sea change happens.
Yeah. You have a great blog post titled Stablecoins and the Collapse of the Legacy Payment Model. I would encourage everyone to take a read at that. I'm curious, what are some of the things that people in crypto get really wrong about stablecoins? Because you often hear, stablecoins are going to transform the financial system. And the reality is it's more nuanced than that. Like you still have to interact with certain pieces of the legacy system. And conversely, I'm curious to get your thoughts around what is something that people outside in the industry get wrong about stablecoins. So maybe
Yeah. So I think on the crypto native side, people are starting to understand that if you have to transact within fiat, that for a lot of things, like stablecoins are actually more expensive. If there needs to be a swap back into fiat due to the FX and liquidity concerns and due to the compliance, it can be more expensive than traditional rails. And so this continuous conversation around stablecoins are, essentially low cost, direct transfers doesn't really take into account how payment flows work. And so that I think people are starting to understand a little bit, but what does that mean? It means we need to be more on chain, right? And I think that gets to, what do, call it traditional people misunderstand about stablecoins on the other side, which is that there is a world in which we don't need to be in fiat, right? A lot of payment flows can happen on chain, right? There's a business called Rain right now who issues cards, right? They issue cards that are stablecoin backed by stablecoins that are in your wallets. They do just-in-time receivables financing and securitization with a protocol called Credit Coup, and they pull that capital when they need. It's much more capital efficient. And then they settle with Visa in stablecoins. And so this is a payment flow that does not need any sort of fiat interaction. And all it really needs is more credit. And so that's kind of the the elephant in the room. And because you're replacing the bank, and what banks really do is they provide credit, you need to get these alternative lenders in there. But if you do that and it's entirely like on-chain payment flow, now it is a lot cheaper. And there is a world where we can go there and we can be entirely on-chain. And so I think that's really kind of bringing those two people and those two points of view together.
Yeah, definitely. Like we've been looking at a lot of like cross-border payments, which I think is one of the areas that it's really picking up. Like for instance, the U.S. Mexico remittance corridor, it's actually really efficient because there's just so much volume. But where we have spent a lot of time on is consumer behavior, right? If you're the end user and you're interacting with Western Union, Western Union has built a pretty decent moat because they have just a very robust network of agents where the convenience factor is people care about, right? I want to be able to withdraw my cash and withdraw it immediately once my relative in the US tells me that he sent the money. Now, what in conversations with Bridge and a couple other providers, they're saying there's been a pretty big shift in consumer behavior where now you don't have to off ramp, right? Yeah. Because you receive, like Western Union would force you to off ramp to pesos, the local currency. But now you're able to maintain dollars, a stablecoin in a digital wallet, might earn some yield. And so that has been pretty powerful. I mean, it sounds simple and it's kind of crazy that people are not able to do that, but it's a very big shift in consumer behavior. So that's to your point around if money stays more digital and you don't have to off ramp, then you just kind of are able to unlock a lot of these efficiencies, right? Because where there exists a lot of friction still is in the on and off ramping and creating like a network where you need to be able to offer that same convenience to the end user.
Yeah, all of the extra costs are at the off ramp and the on ramp, right? And so it's a significantly better product experience if you stay on chain. That's what we need to get to. I mean, it's also, I know we'll talk about this later around like the tokenization of some of these other assets, but this like hybrid model that people are trying to solve for, where there's like this off-chain piece and this on-chain piece, like these are the worst of both worlds. Like these suck. Like you really should pick one or the other, if I'm being honest. And the goal is clearly to be on-chain. And if we can get to being entirely on-chain, like it's going to be much better for everybody involved. It's going to accrue more value to the retail users. It's going to disintermediate the banks, and it's just going to be a better digitally native or internet first experience.
Yeah. So give us like your 1 year, 5 year forecast on stablecoins. Like everyone now is trying to launch a purpose-built L1 that has, focused on the stablecoin chain. Then you're going to have JP Morgans of the world issue their own stablecoin. Who are the winners? Who are the losers in this kind of tectonic shift of financial rails?
You have to own the customer, or you have to own, call it the compliance and like KYC, KYB and banking tech stack. So why do I say that? Those are basically the two endpoints. So I talk about this a little bit in that blog I wrote that you mentioned, but basically the entire middle of the transaction flow is getting completely collapsed. Somebody like a Stripe, who today is already the merchant acquirer, is already the processor and gateway, they can also become essentially the card issuer. They can become the token issuer, and they're essentially the central bank, and they're the issuing bank in those cases. And they can also, if it's entirely on chain, be essentially the network, right? So, you don't necessarily need a Visa, maybe you need a Visa for auth, but you don't need it for, all of the settlement piece. And so if you are able to collapse that entire middle piece, then the people who win are the people who own the endpoints. So what does that mean is like you either need to be like a big global bank or someone with a lot of big global bank relationships who can understand how the complexity of KYC, KYB work, or you have to own like the end of the distribution, right? Like you have to own the end customer. And so I think what we're going to see is somebody like a Stripe or maybe a more crypto native newcomer that kind of looks like a Stripe, who really is really good at product and tech. That will be a huge, huge winner. You'll see maybe the most digitally native bank be a huge, huge winner. And then you'll see the people who own the end customer in, maybe it's a new bank, or maybe it's a digitally native, crypto native, new global fintech, right? And those people are going to be the big winners.
Yeah. On that point, Peter Thiel this week announced with founder of Oculus and I think Andreal, a crypto-friendly Silicon Valley bank rival. Any insights there? Any color, immediate reactions when you saw that?
Yeah, so I knew it was happening. They,
This is called Erebor, which is a weird name for a bank, but let's put that aside for a minute.
Yeah, and it's renamed, and they've had a couple of iterations, and they've done a few things. And people see like clearly, this actually goes like beyond crypto, and it goes back to my earlier point, which is that the bank core and the bank tech stacks at the vast majority of banks is like a complete nightmare and shit show. Like digitally native banks, not just crypto native banks, but digitally native banks have been taking market share and continue to take market share. And being stablecoin first, clearly there's a way to go win a market. And banks are, they're great ways to make money, right? So you see it kind of in fintech more broadly, but every tech company eventually wants to become a bank, and every bank essentially wants to become a tech company. And that's because the banks make way more money and the tech companies get way better multiples. Well, this is obviously trying to solve for that, right? And so I think considering who they are, they're probably going to build a humongous, fantastic business. And like, I don't know how you would get in front of that train considering, their experience and their relationships.
Yeah. I mean, a lot of this like path dependency, it's like, are you able to attract talent? And it's very self-fulfilling. Like they do have an unfair advantage. So yeah. Anything else on the stablecoin front? I mean, there's just a lot to unpack. I mean, we've covered at length, but people should go and read your blog post. Simon Taylor is another really good one. There's an analyst, I think, at what's another fund? I forget which one. Altimeter. She's been tweeting a lot about tokenization, stablecoins.
Yeah, Frida Dwan, right?
Yeah. So people are like, we talked about this in the podcast that you were on a couple of weeks ago, which is this is the benefit of more crypto companies going public. For better or for worse, there's just more attention, there's more coverage, and it just brings more legitimacy to the space. And now, if you want to draw attention at the board level, it's very easy to point to a public company like now Coinbase or Circle and say, well, you got to pay attention, right? It's just a very in your face kind of thing.
I mean, I think people have to understand like how are decisions made at these big companies? They're made at that board level, right? And the board is going to tell management, these are like the 3, 4, 5 things that you need to care about. And these are going to be the focus for the next few quarters. It's much easier for them to say, yes, stable coins need to be a part of that thing that you do or that you focus on and is a core strategic initiative for us. When they see Circle go out and trade up to $60 or $70 billion equity value at these crazy multiples. And, now all of a sudden it's like, oh man, the right thing for shareholder value is to have stablecoins in my business.
Yeah. Last spicy take, because Rob, doesn't shy away from that. You tweeted a couple of days ago. So JP Morgan, which is an underwriter, and I don't know if it was lead left, but it was, top underwriter.
I think they were lead left. Yeah.
They're lead left. Yeah. So they, the equity, this guy, Kenneth Worthington, he is also the analyst that covers Coinbase and has been doing for a long time. They put out an underweight initiation report on Circle with a price target of $80. And I quote, I can't emphasize enough how crazy the Circle IPO has been. And now with an unprecedented initial coverage report from the lead underwriter that has a price target almost 60% below current. Not sure I've ever seen the lead underwriter's initial report be this bearish.
Listen, I mean, but the funny thing about it is $80 would have seemed so bullish.
I don't think anyone was expecting $80.
No, nobody was underwriting $80. And then, if you're to be fair, I don't envy his job because as you're the sell side analyst, and I get there's a Chinese wall, et cetera. But these guys feel pressure to come out and put out pretty nice reports around people that they just IPO'd. And so he's sitting there being like, shit, what do I do? And how do I stay true to who I am, but also, account for how the market has reacted? And the market did not care whatsoever. I think that it's $188 again today.
187, it's up 5% today.
Yeah, exactly. But the funny thing is there's also a lot of crowding. I think GS, who was also an underwriter, was at $83 price target. I think there's a bunch of people around this 80 mark who are just trying to figure out how not to make themselves look like idiots, but also to try to stay true to some subset of fundamentals.
Well, ladies and gentlemen, if you're complaining about low float, high FTV coins, well, let me tell you, it's no different in TradFi because so objectively speaking, there's this lockup period, right? So people that are totally unaware of how this works, there's only so many shares that are offered and it's not super thinly traded, but there's not a lot of shares that go around. And so if you want to short this thing, you can't actually get much because there's not that many shares out there. And so it lends this dynamic during the lockup period where you can have these crazy spikes in price. But we'll see. We'll see what happens after the lockup. Right? I think it's 90 days, give or take.
I believe. Yeah, I believe we're actually mostly 60 days in this one.
60 days.
I'd have to go confirm, but I believe it's mostly 60 days for Circle. The one thing I would mention is I was talking to like one of the companies or a company and a founder who would know about a lot of the flows and was actually like looking at the tape and saying like figuring out like where all the flows are coming from in Circle. And he was like, they're all the retail brokerages. Like this is all retail bid. This is not institutions coming out and saying, yeah, like we need access to, payments, stable coins. Today, it is basically a meme coin, at least according to this person that I talked to.
Yeah. Yeah, I'm not surprised. I mean, and this is kind of it IPO'd to what, 6 billion-ish?
Yeah, so $31 was a little over 6, close to 7. So
yeah, I mean, this just like it doesn't take much capital to push these things up, and in a similar way, like everyone's now charting M2 and Bitcoin price. Like as much as crypto's grown to a pretty sizable, is a $2+ trillion asset class, like it doesn't take much capital to push these things up. And like there's a dynamic where like if you're a large hedge fund, I don't know if they're putting a position on Circle or not, but like there are all these arbitrary thresholds that you can't, like if you're a massive fund, you can't really invest in anything sub 10 billion. And then once it crosses 50 billion. So these are these weird things, like when Coinbase got listed into the S&P 500, right? It just, the flows movement just ripped, right?
Yeah. I've got my first couple like emails like, hey, I'm leaving Circle. I'm, looking for my next opportunity. Might take a little bit of time off. And I think the employees are excited about what's happening.
Yeah, funny enough, I was looking at the data, right? Because I was close with one of the early investors in Circle. And I remember going back to 2014, 2015. And my whole thesis was like, does it actually outperform Bitcoin? Because that's, I think, always the barometer, which is whatever you're investing in crypto, it should, outperform the underlying. And it didn't. Wow. As much as it's been a fantastic return for them, like, it didn't outperform Bitcoin. And so you wonder, like, as an allocator of capital you are, what where to park your capital. It's very, very hard to outperform Bitcoin.
Yeah, but who is the biggest shareholder in Circle? Like I think it was Marshall Wace, right? Because could Marshall Wace have gone and like bought a bunch of Bitcoin in 2018 when they did that deal? They couldn't have, right? And so this is
it was General Catalyst and Briar Capital, I think, were one of the
seed round. Yeah, but
round. Full
and then
ownership.
Marshall put a bunch of money in like 2018 through 2020, I think.
Yeah.
This episode is brought to you by Geodnet, the world's largest decentralized RTK network delivering real-time, centimeter-accurate positioning around the globe. Powering technologies that enable precise navigation for drones, autonomous vehicles, first responders, farmers, and robotics, Geodnet shows that blockchain can be a truly transformative force. By delivering real-time centimeter-level accuracy, Geodnet enhances emergency response, boosts construction precision, and enables advanced navigation for drones and surveyors far beyond the limits of standard GPS. To find out more, click the link in the show notes or follow them on X. Hey everyone, Jason here. Earlier in today's episode, you heard me mention the weekly CIO Memo from Bitwise. In an industry as hectic, fast, and complex as ours, it's incredibly hard to get an easy, no-nonsense stream of what's actually moving crypto. The memo comes from Matt Hogan, Bitwise's Chief Investment Officer. He's been on the show before, and he has this amazing ability to take the most complex topics and break them down with clarity. Trust me on this one, the Bitwise Weekly CIO Memo is really worth the 5 minutes of your time. Check it out at bitwiseinvestments.com/CIO memo/empire, or just hit the link in the description of today's episode to get started. Carefully consider the extreme risks associated with crypto before investing. As always, investments in blockchain technology involve risk, terms, and conditions apply.
The institutional allocators prefer to invest in startups with like legitimate teams that they can underwrite, go to committee, and there's this like, they get paid to do that, right? And I think it would be hard to like put a couple $2 billion or whatever, how much capital Circle raised into just Bitcoin.
Wait, beyond that, by the way, there's also like my LPs want to hear me talk about, who my founders are and like why we invested in them. And they're not going to pay me 2 and 20 to buy Bitcoin because they can just go to do that themselves. The question they have to answer is like, do they want to put money into my fund or not, relative to just buying Bitcoin? But once they put money into my fund, like they do not want me to do stuff like that. They want me to go and tell them like what is changing the way financial markets work and how do they have exposure to that?
Yeah. Maybe as a side note on that, like, has the conversation with LPs really changed over the years? Are they more focused on this type of stuff, or do they take an interest in particular areas? I'm kind of curious if there's general insights that you've observed over the years.
Yeah, it's definitely changed a lot. The LPs, call it in, pre-2021, they didn't really have any access to the space. Some, obviously the more sophisticated ones had bought Bitcoin, but the institutions hadn't. They didn't really still know the story. Maybe they had, thought about it a little bit in 2018 when we ran up to 19K or a little bit earlier, but they just didn't know that much. And you really had to walk them through what was happening, why it was happening, why blockchain rails and why crypto were, a good asset class for them to be investing in. 2021, everyone got just so much FOMO. It was just, they were looking around, they were looking at the price action, they were looking at the CNBC headlines, and they were like, I'm going to get fired if I don't actually get some exposure to this thing, and I've got to put money in as quick as possible. But there was still extremely little amount of knowledge about like why blockchain rails were good for money movement, like why there was a reason for DeFi to exist and how DeFi could potentially replace certain types of traditional financial instruments. Now, today, frankly, all the LPs pretty much get it. They understand the story. They may or may not believe you. They may think, I think you're full of shit. But what they do believe is, or they do understand why it is going to exist. And almost all of them believe in Bitcoin at this point. And at least that Bitcoin will continue to be a store of value, whether they think it should be or not, because for some ideological reason. And so now it's about telling them like, this is actually the future of money. This is the future of capital markets. And if you want somebody to get you exposure to how capital markets are going to exist 10 years from now, you have to invest with me because I'm the one who has that expertise and understanding. And so it's sort of the same story, but less education needs to happen.
Yeah, definitely. Transitioning to something else that has been ripping is Hood. This is Robinhood stock. I mean, it's been on an absolute tear. We're here to talk about insights and news stories of ECC. There's really just one, and that was Robinhood announcing this tokenization of like certain private, companies' stocks. Should we just spend a minute? I'd like to just the next chapter of the segment, just covering all of that. So for a little bit of background, feel free to jump in here with the particulars, but like Vlad was in Cannes and he was unveiled this opportunity for Robinhood users. I think it was only EU users.
So it's only EU users. So Robinhood EU, which is just Bitstamp, which by the way, before we even go into the specifics, how good did Vlad look in that suit? So you got a little close to him at the event. You could kind of see through the shirt. Like he was a pure capo there. I mean, I saw someone comment of like, Vlad went to his stylist and said, "Make me look presentable," and somehow they made him look like a crypto scammer. But look, we appreciate it. Was boiling hot in Cannes. I don't know how he was like weathering that, but there's a lot of people in that event. You're starting to see how companies like Robinhood, like we talked about Stripe and how forward-looking they've been. Robinhood, again, founder-led organization. Vlad has been all over it, and it's not new. The Bitstamp happened a while ago. They've been integrating that. Let's talk about that. Like, so I think there's a lot to unpack, but like at a high level, this gives people an opportunity to have exposure to these private companies. And I think it was like OpenAI and SpaceX and maybe a few other companies, right? So there's two different products that they announced. And so like, maybe I'll level set on two of them or both of them. So on they announced the public company side, like tokenized like public equities. And I think I got a little confused. And I even tweeted about this a little bit, that with the X stocks announcement, which was also what, Kraken and Bybit and Gate and a few others are doing on Solana. But maybe on the Robinhood side, basically what they announced was that they're going to or allow you to enter into a derivative contract with them that trades 24/5, so still doesn't trade on the weekend, cannot be taken off platform. So they'll give you a token, but it looks in your wallet like no different than if you just own the equity itself. they're charging a 10 bips FX fee. So because of your Bitstamp or Robinhood Europe user, you have euro, but then they're swapping that euro for 10 bips into USD, and then they're swapping with up to a 50 bip spread to go buy the token itself. It's still T+1 settlement on the FX side, and it looks essentially in every way on platform like it's a traditional equity. And so you ask, like, what problem are they solving? And the problem they are solving for that product is essentially just that they don't have the license to go offer equities, right? like that is the problem they are solving. Like, they're competing in Europe with Revolut and with a bunch of these other fintechs who have the right licensing in Europe and are offering US equities through like Drive Wealth and Alpaca and like these other providers, and Robinhood just doesn't. And so they're made a big deal about the tokenized equity piece, but it's essentially just a kind of, I think, a little bit of a reg art for them right now. Now they do say that they're like setting themselves up for a future of being much more on chain, and they want to have their own chain that's on Arbitrum, et cetera. So I'm excited about where they're going, but I just want to be like very clear about like what that product is today.
Yeah, it's a Robinhood chain. It's deployed on Arbitrum, and it gives European customers the ability to buy tokenized US stocks, I think over 200, and ETFs, right? Yeah,
but there's no interaction with any permissionless chain for you, the user, right? Like they're going to settle, they're going to batch settle. Today, it's actually going to be entirely on Arbitrum. In the future, it sounds like it's probably going to use like the Orbit tech stack, but it's probably going to be directly settling to ETH instead of settling to Arbitrum. So it's not going to be like an L3 or a sidechain. So I think it's like kind of unclear. The private company stuff is a little bit different. Yeah. And so like that's the public company. The private company stuff, there was obviously some hoopla about this on Twitter yesterday, because they said that they were giving you private company stock, and then OpenAI came out and said, like, we're definitely not allowing transfers. And it turns out that it's the structure of it is pretty similar to what you've seen in other types of structures, where they are buying, or they've been able to buy or source some equity from, OpenAI employees or early investors. Same thing with, I believe it was SpaceX, and they're putting it into an SPV, and they're allowing you to buy some fraction of that SPV in a derivative contract again. And they kind of, again, like a completely permission, like, in their app program. And so again, it's tokenized, but there's not necessarily like any interaction with crypto, at least today. And so again, I think it's important to say, like, it's exciting that we're having these types of conversations, but the product as it exists today isn't solving a lot of problems for much of anyone, other than, frankly, like a little bit of a regulatory arbitrage for Robinhood specifically.
Yeah. I've looked at the video, and look, I'm sure they thought extensively about how they were going to position it. But I think it's important, if you're a founder, if you're a company, like, I don't know if it was a feature or a bug, but I would have done it differently, is all I'm saying. Yeah. Because you should have, like, what happens? Like retail, like Robinhood is a retail focused platform. The worst case is, imagine if all users are flocking and buying this thing, because, these are companies that people want to have exposure to. In a worst case scenario, you have a ton of interest, a ton of people unsuspectingly buy this, thinking that they're going to get on the cap table. And that's not the case. And if you're not on the cap table, then this might fall apart. I mean, it has a whole set of nuances and considerations where, obviously there's backlash with OpenAI. Like, it is, some companies like Stripe, for instance, doesn't allow, like, there's all these transfer restrictions on stocks. I mean, as far as I'm aware, Stripe, I think it's like 100 billion in the secondary market. The company tenders back shares. Like, if you're an employee, you want liquidity, the company pretty much like every quarter or so is buying back these shares. And they're very, very guarded as to who you can sell them. And most companies are like this. And so, I think it's, I would have done it differently. I wonder why they didn't do it this way. Maybe they were intentionally opaque about it, or just, but it's just a word of caution, because if you're in crypto, what you don't want is, this is what we have wrong as an industry, just be transparent, maybe hold off on the announcement, or maybe go talk to these companies. If you take the long path, like, now you have backlash from OpenAI, and now there could be a more scrutiny. And so I wonder if this actually jeopardizes their capacity to maybe do something interesting, where you go and structure these things and get employees liquidity. I don't know.
Yeah, my maybe my perspective here is that the biggest problem they made, to your point, was just how they talked about it. It wasn't actually the product itself, right? Like, it's actually really exciting that people can get, more access to, like, private equity, Tesla and OpenAI and SpaceX. It's, exciting that people in Europe can get access to these public equities through, the Robinhood platform when they couldn't before. My expectation or my concern is that they talked about it in these big kind of like crypto promise ways, and to get everybody like super hyped up about it. And even the event, I mean, I don't know if you went, but I was there for part of it. And, they kind of, there's this air of like, oh, it's like really exclusive. Like, everybody is staying at the best hotel. They're getting on a shuttle that only the shuttles could go up to this, essentially this like chateau that like then was like, he was presenting. And it was really all about this like air of exclusivity that they were trying to go out and foster. And then they talked about a product in a really opaque way that really is like is pretty simple. And it was really about this like future looking version of like what they want their on-chain, or maybe what they want their like on-chain future to look like, and how they want to interact with permissionless blockchains. But it got people expecting something different than what the details actually were. And that is the worst thing you can do. Like, you need to have clarity in language. You need to have clarity in the way you communicate. Yeah. And that is why there's been so much confusion and backlash at times, at least, on Twitter and elsewhere.
Yeah. Yeah. I mean, look, if it were up to me, I'm sure there's some regulatory stuff, but it's like, hey, this is a derivative contract. It's going to track the price of the secondary market of these things. And look, if you've observed, we're going to give you, like, this is maybe how the Oracle works, and we're going to take a weighted average, and this is the calculation. I mean, maybe as I understood it, it's sort of like that. You're going to, and then I have questions around, well, how are you calculating this, and who's shorting it? Like, who's taking the other side of the position? How are you managing that? And like,
so they did come out eventually, and I don't think this was a publicly released at the time. So they came out eventually, and now what they've said is they're using like Carta and Forge secondary markets as sort of like a pricing agent to try to kind of pin or track the price that you're seeing on Carta or Forge. I think there's like a lot of confusion still around, like, do you own common? Do you own like a pref? Like, what should a common or pref trade at? I think it's very unclear around, or it's not unclear. You actually, that you have no actual rights. So like, what is your legal right, relative to Robinhood? And then Robinhood is actually, has this SPV, and are there other owners in this SPV? Like, some of that like legal structure is unclear. But they did at least say they're going to try to use, secondary markets at Carta and Forge, and have some sort of like pricing agent to help you like bring some sort of transparency into that pricing.
Yeah. Look, I don't disagree with you. I mean, in the best case, we get more liquidity, more transparency into the secondary market. Like, crypto is a good engine to bring price discovery with liquidity. And so, it does play into access. Like, most people don't have the opportunity to like invest in US stocks, which is a huge win, I think. And then there's obviously a lot of people that don't have access. Like, most of the value generation over the last, 2 decades or so has been in the private markets. Companies are staying private longer. And, not everyone can get access to that. So, hopefully you see the promise of where it can go. But I do think we have to go a long way. And as an industry, just be a little bit more measured in how we like make these announcements. Because I think there's, especially in moments like these, there's a lot of hype. There's a lot of expectation, especially as a public company. And so I think, yeah.
Yeah. Well, and by the way, Robinhood stock was up like 12% after the announcement, just like completely ripped. And I would say this, like, I would contrast this a little bit with like Republic had an announcement about also distributing private shares, I think specifically of SpaceX, like last week. And they did it in the way that you see these things are typically done, which is that they did, I think, a Reg CF. And so like everybody could, they could only distribute up to 5 million over a 12-month basis. Everybody had to be, KYC'd, AML'd on the Republic platform. The Republic was telling people that we don't actually have the shares yet. They were very clear about that. But if we get up to 5 million of interest, we will go and acquire the shares. This is what we think the target price will be, which I think on their platform was they were targeting between a $400 and $500 billion valuation for SpaceX, which is like absolutely incredible. But that was the way that these things are typically done. They're done in a regulated manner, and Republic deciding to do it in kind of like this unregulated manner is a little bit odd. And then on the public equity side, to your point, like in Europe, people have access to cheap US stocks. And so the distribution point for the users doesn't really make a ton of sense. It makes sense in India and Southeast Asia and places where people actually don't have access to public equities. But in Europe, people already have that access. And so it really felt to me like, hey, we want to tell a really good story for the public market, and then we want to do a little bit of regulatory arbitrage.
Yeah, totally. To your point on Republic, I like the way they called it, which is mirror tokens.
Yeah.
And that, I think, name is more reflective of what this instrument actually is doing. So as they called it, mirror tokens, a new type of token tied to the performance of the world's most valuable private companies. I think that's a very elegant way of saying it, right?
Yeah.
And so that's probably, a big contrast there. And Republic's been quietly doing this for such a long time. I mean, I was a seed investor, an advisor at some point, Ken. It's good to see them come out of like, it pays to play the long game, and they've taken the harder path, which is trying to do this in a very regulated manner and never compromising, I guess, their ability to operate, which I think is so essential in this space. Like, we're just getting started. Like, don't do anything that puts you out of the game. So it's good to see this.
Yeah, and I think the one thing I would maybe end us with, or maybe we move on to like X stocks and some of the other solutions, but the other thing I would say is like there is going to be more regulatory scrutiny on a tokenized equity that is trading on chain, if and when Robinhood allows these things to be transferred on chain, than there is on like name your token today that trades on Jupiter, right? And so like we do need to be, I think, a little bit more thoughtful around how we think and talk about these things, because if we get too ahead of ourselves, like you're going to have a bit of a snapback against even this regulatory regime, which is obviously much more friendly to the administration or to us than prior administrations have been. And so I think that's an important point. And then I think the other thing here is I expect we'll continue to see more and more transfer restrictions and language on transfer restrictions in shareholders agreements be tweaked to include things like affiliates and subsidiaries and SPVs, so that because the companies, especially the private ones, they don't want this to happen. They don't want their stock out there trading, especially not permissionlessly, and even within Robinhood, unless they facilitate it themselves, they control the environment. So I think we're going to see more tension directly with people like OpenAI, which you've already seen here.
Yeah.
This episode is brought to you by Geodnet, the world's largest decentralized RTK network, delivering real-time, centimeter-accurate positioning around the globe. Powering technologies that enable precise navigation for drones, autonomous vehicles, first responders, farmers, and robotics, Geodnet shows that blockchain can be a truly transformative force. By delivering real-time centimeter-level accuracy, Geodnet enhances emergency response, boosts construction precision, and enables advanced navigation for drones and surveyors far beyond the limits of standard GPS. To find out more, click the link in the show notes or follow them on X. Hey everyone, Jason here. Earlier in today's episode, you heard me mention the weekly CIO Memo from Bitwise. In an industry as hectic, fast, and complex as ours, it's incredibly hard to get an easy, no-nonsense stream of what's actually moving crypto. The memo comes from Matt Hogan, Bitwise's Chief Investment Officer. He's been on the show before, and he has this amazing ability to take the most complex topics and break them down with clarity. Trust me on this one, the Bitwise Weekly CIO Memo is really worth the 5 minutes of your time. Check it out at bitwiseinvestments.com/CIO memo/empire, or just hit the link in the description of today's episode to get started. Carefully consider the extreme risks associated with crypto before investing. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Have you seen the movie The Big Short?
Yeah, of course.
You know those scenes where like Richard Thaler or Selena Gomez or Margot Robbie goes in there and explains like this weird like complicated financial name. So let's just do the same here. Mirror token. So nothing stops you and I, Rob, from entering into an agreement where we bet on the outcome of a particular company. So like, let's pick, OpenAI. Yeah. I say, hey, OpenAI is going to be $1 trillion business. And you say, you're absolutely out of your mind. I take the other side of the bet. I say it's going to be X. And then we
would never do that. More than $1 trillion.
Well, you know what I mean? Like, so say that you were not agreeing with me, but you would find a counterparty that would take the other side of the bet. And that's how you would structure as a normal bet would, right? Patriots versus Chiefs, no different
Totally.
than OpenAI. You just select the price and then you assign some sort of payout structure and you enter in a handshake agreement, no problem, right? Derivative markets are vastly larger than spot, like notional markets. Like they're just huge, huge, huge. And that's, as I understand, like this is, I think nothing stops you from doing that. I mean, there's some like regulatory considerations and stuff, but so that's effectively what this mirror token is in some ways. You need a, like synthetics try to do this back in the day where they had the synths, and I think if Kane were listening, you know, a lot of people were not as sophisticated because when you were minting SUSD, you were basically shorting, and so you had to like make sure that you didn't accrue bad debt. So these are like hard problems. Like you got to manage the book in a very good way, and so you're somehow trusting this platforms to like, if you're not doing it directly as you and I have like done it right now, someone is going to have to do that for you. And you're hoping that there's no counterparty risk because,
there's always counterparty risk.
There's always counterparty risk. You run away and don't honor it when we try to settle. There's a whole myriad of counterparty risks that you're trusting Robinhood or you're trusting Republic and how they're doing it. And then maybe the companies, you know, there's backlash. You actually maybe not be settled. And so you never get the shares. And there's a whole set of things that if you don't do it the right way, it can really backfire, right?
In Robinhood, I think there's like 3 or 4 layers because like you're trusting like Robinhood Europe, then you're trusting like the US broker dealer that is, you know, acquiring these shares or has acquired these shares for the SPV. Then you're also trusting like the SPV administrators, right? And so like there's like 3 people there, and then you have OpenAI on the other end. And so like, I mean, you know this, and you know it's maybe something that's a little foreign to some of the listeners. But counterparty risk is probably the number one thing I used to talk about when I worked in traditional hedge funds, like more than anything else. It was always about counterparty risk.
Yeah, no, totally. I mean, Lehman, like these organizations blow up. Abacus, these things can get really out of hand. Speaking of counterparty risk, I was just on a panel of ECC, I guess, and we were talking about DeFi, and we ended up talking about this because the whole point was there was like a couple of folks there from like traditional, like I guess not traditional, but like DeFi protocols. And it's so common. These people just like talk a very big game. It's like, we're going to blow up JP Morgan as we know it. It's going to cease to exist. And I find it all a lot. It's odd, but these people like haven't worked in TradFi. So it's like, well, not really. But I've been now enjoying like, ever since my TradFi days, like, can you walk into and talk to your friends in TradFi and not mention crypto, but mention like the underlying mechanism and system and get them excited? Right? Can you talk about stablecoins without calling them stablecoins? Can you talk about DeFi rails without? And one of the things, as you were saying, counterparty risk. This is one of the like core primitives that it's not to say that DeFi is going to blow up TradFi, but like the way I would describe it to folks at JP Morgan, it's like, hey, imagine if you had the ability to assess collateral 24/7, 365, and you can inspect that in real time. You not like entity level, system wide, protocol wide, and so you never get yourself in a position where you can actually monitor counterparty risk in a more precise way in real time. And if you just say that, they'll be like, oh, that's really cool. Amazing. And then you're like, oh yeah, well that's DeFi. And they're like, oh no, we can't touch DeFi. This is terrible. This is snake oil kind of thing. But these are some of the properties that I think as an industry we're better off. And your point around stablecoins, just to go back there for a minute, really does that well, which is don't necessarily think about what you're going to disrupt, but more of what is sort of like a new primitive or a new benefit that was just not possible before. Flash loans, composability, atomic transactions, 24/7, 365, reducing counterparty risk, your ability to measure risk in more real time. Like these are some of the things that if you're just taking the very narrow view of like, what are we displacing? You sort of miss perhaps even the bigger picture of what is possible with this technology that I think is worth, I've seen sort of the best founders think like that. Whereas,
by the way, this is like the way you are supposed to get people. This is how you sell. You don't go and sell to somebody by saying like, "Hey, like this, we're going to disrupt your business or somebody else's business," and like nobody is like, "Oh yeah, sign me up for that." You go and tell them like, "I'm going to make you money, and I'm going to make your life better, and I'm going to reduce your risk, and this is how I'm going to do it." And then they're like, "Yeah, sign me up." Like absolutely, right? They never are. You never go. You never say you're going to cut costs. You always say you're going to add revenue. Every time.
Yep, that's very true. What else should we talk about? Is there anything else on the tokenization stuff that we should cover?
Did you want to quickly touch on X stocks, because those are actually being traded on Solana right now, and on Jupiter and Radium, and you can use it as you can do securities lending essentially on Camino.
Yeah, let's do that.
Yeah, so just quickly, maybe I'll talk about how they're a little bit different. So these are in somewhat of a similar manner. You go and you can buy them through right now Kraken or Bybit. I think Gate is going to sign up as well. I expect we'll see other exchanges sign up, and you KYC AML. You go and you put in an order to buy one of these. They mint a token, and what's happening on the back end is a company called TradFi is acquiring that equity into a SPV that they control, and they're regulated in the EU, I think, through Liechtenstein, and then they're minting that token, and so you now have that token like in your Kraken wallet. But now actually those tokens can be transferred to your Phantom wallet or any self-custodial wallet on Solana, immediately supported to do securities lending on Camino, immediately supported to go and swap on Jupiter. And so we saw a lot of people, I think, tweeting about this and getting really excited about this, because now it's like, oh, equities are in DeFi. I think I had a tweet about this, that I think there's a lot of, again, like structural issues here that created a market that, or probably going to create a market that is kind of the worst of both worlds, that aren't really allowing us to completely take advantage of being on chain. And also we have a lot of this, call it counterparty risk and risk and off chain and regulatory risk that exists. And so, that was X stocks. And I think that was kind of caught up in the Robinhood announcement, but that even is a step farther, because it's in many ways sort of like the Robinhood announcement, but now you can actually use these things in DeFi. Yeah.
There's a decent amount of liquidity, but I saw some comments around like the price was just being totally off. There's not enough liquidity in there. I'm curious, like what in what you've observed, obviously it's early days, but like what could go terribly wrong? And then let's just focus on the downside of how this could break. And then we could talk like the upside, everyone kind of knows, but like, how does this actually break, and what's the worst case for this type of stuff?
Yeah. So there's been about, I think there was like $8 million of volume yesterday. And so there's a little bit of volume on chain. But actually, if you look at Amazon, there's like $700 of liquidity right now. And so there's zero, essentially. I think Tesla maybe had, was it Tesla? No, it was Apple who had maybe like 70K. Then I think Tesla actually had like $1 million of liquidity. And so these are, in Radium pools, you can swap it through Jupiter. And so you're seeing kind of like a wide disparity of like where people are willing to provide liquidity and where they want to put money into the AMM pools. Mm-hmm. There's, I think the concern I have, and I talked about this a little bit on Twitter, was there's actually like no real way to market make these economically on the weekends. After hours is also really tough. And so what I'm concerned about is there was essentially like this immediate, oh, hey, we're going to, do securities lending against this on Camino. We're going to immediately allow for swapping on Radium and through Jupiter. And there's this likelihood that there's no sophisticated market makers on the weekend. And if there will be market makers on the weekend, they have to go and hedge off chain. Well, you can't actually hedge if you're if you're somebody that is, if it's during, I guess, off market hours, if it's not on, during those market hours. And so they actually have to hold, that market maker has to hold that risk for that entire weekend or those after hours timeframe. And to be able to hold a risk for an entire weekend when the world is changing as quickly as it is, they're going to have to like blow out the spread, and pricing is going to get like all wacky, and it's going to be uneconomical for professional traders. And you're just going to see kind of like, unsophisticated retail trading these during those periods of time. And I'm worried that now that they're going to be used in Camino and potentially derivatives on top of that, you're going to see a lot of like cascading liquidation risk on chain. And so that's one of the things that I think is we need to be thoughtful about very early on.
Yeah, no, absolutely. I'm trying to share my screen here because maybe you can see it or not, but CoinGecko has actually a good dashboard here that tracks, I believe this is correct, like X stocks ecosystem. And you have, just to your point earlier now, like you have the most amount of volume on a 24-hour basis is the S&P 500 X stock. And that has 1.6 million of volume. Yeah. And then it drops off pretty dramatically. I guess NVIDIA had a lot, Robinhood, X stocks, Circle, and NVIDIA, but it's very thin liquidity, right? And And so just going back to the problem that you observe on the weekend, let me know if this is terribly wrong, is because someone needs to take that risk over the weekend. There's a counterparty in there that, you're going to have to settle on Monday. And if there's a lot of movement over the weekend, or it's, especially when it's thinly traded, it lends itself for like these very big fluctuations. Someone can be caught off guards really, really badly there.
I mean, all of us, I think, who have been in crypto long enough understand or have seen how these like thinly, like low liquidity weekends might just like cause like cascading issues. And these are even for like much more liquid markets. And to your point, like there is a market maker out there who will make this market, but they might, blow out the spread by 5%, right? Yeah. Which means that like you might just be taking a 5% haircut the second you buy this token on the weekend, and you don't have the upside of like a meme coin. Like I had a bunch of people tweet at me like, oh, haven't you seen that people are willing to take, 10% slippage or 15% slippage to go and buy like Fartcoin? I was like, yeah, that's because everybody thinks Fartcoin is going to like 4x or 5x
100x or bust,
Yeah, exactly. Right. Like are you really going to take a 5% haircut on day one in the hopes of making 7% or 5% or 2% on an Apple move, pre-market hours on Monday morning? Like in the vast majority of cases, no. Right. But the sophisticated actors, like that's what they're going to do, because if they realize that like retail doesn't care and there is that demand otherwise.
Yeah. Yeah, I mean, excellent point. Like, imagine if you're using these shares as collateral, and there's a huge fluctuation over the weekend because there's a whale that wants to liquidate you. Like, we've seen this like pretty adversarial environment in crypto where people can, because people are seeing your position in real time. I mean, I don't know if these are like accepted as collateral, but let's just say that in Camino you can borrow against.
Yeah, Camino, yeah.
You can borrow against Circle shares, right? You want to go short Circle? There you go, ladies and gentlemen. None of this financial advice. I'm not, but right now it's tracking fairly closely, I guess, like 187, but over the weekend, it'd be really interesting to see how this plays out.
I mean, some of the low liquidity ones were trading at it like I think it was Apple I was looking at today. It traded at a solid like 7% discount at some point. And like I said, there's only like 70K of liquidity. I mean, it's early, right? And so we'll see what happens. But there's, I think there's a lot of DeFi risk here. Especially because like you can't arb it easily, right? So somebody, if you want to arb the transaction or the price differential, like you have to go back to Kraken or Bybit or one of these places. You have to be KYC AML. Then you have to go and redeem the token for whatever the off-chain price is, not the on-chain price. You pay 25 bips, and it's getting those transactions, that redemption is getting batched. And so there's no way to go and do like automated, high frequency arbitrage trading here. And so it's like really hard for any sort of like sophisticated actor to go and figure out how they want to actually, play this in times where the equity markets aren't open, right? Equity markets, when they're open, it can be okay. Equity markets, when they're not open, especially on the weekends, like it just strikes me that I don't know how these are going to work on chain until more of the flow is natively on chain, until we have primary issuance natively on chain.
What do you mean by that? Because people might not appreciate that.
So these are essentially like secondary transactions, right? Because somebody else is buying them and they're selling you like a wrapped version. Wrapped versions of things exist all through traditional finance, right? Like ETFs are wrappers, right? That doesn't mean it's a problem, but you need to have like a native market on chain that is separate, because that way people can actually hedge more easily on chain, right? And it doesn't also matter if there is a structural reason that a thing trades at, a discount or a premium, because there is the native version of that can be used to, to short, to hedge, et cetera. And so that market, I think, actually will be really interesting. There's people like Superstate trying to figure that out, where it's like, okay, well, put 95% of your float with CompuServe, and put it on the NASDAQ, and then put 5% of your float with Superstate and put it onto, an AMM pool and into DeFi. And if that's the case, those markets are completely separate. They're not dependent on an oracle. They're not dependent on each other. And so you will just actually see like really sophisticated actors play them separately, and they don't have to hedge off chain in that case.
Yeah. Because it's not a wrapper. It's like natively issued on chain. And so that even though the float might be low, it's still a native. So you don't have to go through this like multiple step process to actually do the ARB and close the gap, right?
Right, because if liquidity gets pulled on this thing on chain, it can actually go to zero, right? And it could actually go to zero unless you go and you redeem it, and you redeem it for that off-chain price, right? So like that's the you have that right to that off-chain price that is coming through the Oracle. If it's native, it can also go to zero, right? But it's entirely dependent on the liquidity and the supply demand dimensions of like what is happening on chain. You don't ever have this like gravitational pull back to whatever that whatever that off-chain price is.
Yeah, definitely.
Earlier in today's episode, I mentioned Ledger's latest products, the Stacks and Flex, and I wanted to take a few seconds to tell you more about them. These wallets feature the world's first secure touchscreens, which don't just simplify your digital transactions, but also keep them extremely safe. These wallets are virtually impenetrable to online attacks because they store your private key in a secure offline chip. You can manage more than 5,500 tokens and install up to 100 apps. Choose the most trusted name in hardware wallets and take control of your digital security today at ledger.com, or hit the link in the description of today's episode to check out their latest wallets. I wanted to take a moment to tell you about Citrea, the ZK rollup expanding Bitcoin's utility without sacrificing its security. Using ZK technology, Citrea enables Bitcoin to function as a fully programmable financial platform. Citrea is optimistically verified by Bitcoin, offering the most secure and native way to extend Bitcoin's utility to DeFi. With Citrea, developers can build scalable payment systems, tap into Bitcoin's liquidity with financial applications, and build privacy systems. Citrea is currently on testnet and approaching mainnet. To follow their progress, click the link in the show notes or follow them on X at Citrea_XYZ. As always, investments in blockchain technology involve risk, terms, and conditions apply.
A lot happening in tokenized stocks. I mean, let me ask you a question, Rob. If we were to have talked like a year ago or even 6 months ago, would you have expected to be in a state of the world where in July recording and saying all of this is happening now? Does it feel surreal? Were you expecting it?
No, it's surreal, man. I have to be honest, like I expected a lot of things to happen this year. I expected there to be just a lot more, regulatory clarity. We haven't quite gotten that yet. It looks like Genius Act is going to get passed pretty soon on the end of the reconciliation, but it's taken longer than people expected. I think there's a lot of concerns around when clarity gets, whether that gets passed or not. But I expected that to happen. I expected people and institutions and traditional trading firms to continue to dip their toe in. But I didn't expect there to be a few people on the stablecoin side and Robinhood to accelerate as quickly as they are. Even if it is a lot more like window dressing, it is at least the right direction. And it's something that we should all be excited about. And I tell you, actually, the most surprising thing to me is just how shit the alt token market has been relative to everything else we're talking about. Like, there's so much excitement about some of these equities stuff. There's excitement about actual equity public company treasuries that are buying crypto tokens. And yet there is no excitement about like all of the tokens that people were investing in and talking about a year ago.
Absolutely not. Yeah. I mean, there's all the liquidity has been pulled and is going, to public markets. What does that tell you about the state of crypto? Is this anything more than a casino? Like, are people like, what happens in a world where you have now these tokenized public vehicles and people are like playing the NAV premium and how you kind of know how that ends, but what's your like prognosis maybe like for the next year or particularly like the next 12 months? Like, do we continue to just see more and more interest, more and more ability to, people investing more in the public markets and just don't catch a bid? Or I know you guys are mostly focused on venture, but like as a personal opinion or view, like how do you see that unfolding?
It does feel like, at least in the near term, like it's going to be really tough for liquidity on, all of these alts. I was at this, so I was in Cannes, as you mentioned, and I was at this other event over the weekend that was kind of like high status, high value, kind of GPs, LPs, some founders that were just talking about the state of the market. And they did a VC panel, and I wasn't on it. I was in the audience, But the VCs that were up there spent like literally like 60 or 70% of the time that they had to talk about what they're excited about in crypto to talk about these treasury companies. That's all they talked about. And these are like venture capitalists, right? And I mean, this is what I am too. And I'm really focused on, early stage companies. And everybody's looking around and they're like, how do I figure out a way as an asset manager to make money? And they're all pulled into the shiny new thing of public companies because there is no bid by the trading firms for alts. And I think that's been the concern. And I was telling somebody else this morning, like there are clearly two different markets. There is the like on-chain crypto native, like degen market, who mostly just cares about like a few, revenue generating type, like
Hyperliquid and a few others.
Yeah, Hyperliquid, Athena, Aave, like those types of guys, right? And then, and that's not a lot of liquidity, because then the other thing those people care about is Fartcoin and pump when it launches and this stuff. They don't care about any of the other stuff that like people are talking about. And then there's like the institutional bid, right? And to go back to what we talked about earlier, like when I was at the Goldman event talked about a couple things. It talked about Bitcoin, it talked about ETH, it talked about Ripple, and it talked about Canton. Mm-hmm. Those were the things they talked about. They didn't talk about, there was a little bit of conversation about Hyperliquid in there as well, but there wasn't conversation even really about Solana that much, so a little bit. And I actually, there's another conversation to be had here about how I think like Solana is the Silicon Valley token and Ethereum is like the Wall Street token. I actually think that like I have this mental model for this that's happening right now. But those are the things that they wanted to talk about at Goldman. They didn't want to talk about any of the other things happening in crypto. They wanted to talk about that and stablecoins.
Well, go study the history of innovation in crypto markets. And I think if you're a builder out there, do you really want to be doing the next public company tokenization strategy? No, I mean, I think now the meta is revenue generating tokens. I mean, like, okay, like you should have been building that. Like you always should be building revenue generating things, ladies and gentlemen. But yeah, I think, price is obviously very distracting. And it's funny how Wall Street just gets obsessed with these things. But look, I mean, if you objectively like going back, like over the last 9 months, you had a total 180 on the regulatory stance. We have 4 years of really getting policy right. There's been a lot of work. The stablecoin stuff is not new, but it's getting a lot of attention, and that has like ripple effects into the other stuff that's happening in crypto. And you might be in a position where the design space for tokens actually improves. And so who knows, like one of the things that would be really interesting is, so the circle effect for stablecoins it was important in a world where you have Anchorage or Fireblocks or Chainalysis, or I guess the exercise is, what are the next 5 companies that are going to go public in crypto, putting aside these like treasury vehicles, and what is the second, third order effect in the crypto ecosystem? I'm kind of curious if you have a view.
Yeah, I mean, I guess I didn't like fully answer your last question, so I do want to take a quick step back, which is to say, I actually am long-term bullish to the same thing you said about markets. Like markets are cyclical. The second that everyone calls for the death of Ethereum, it trades back up. The second everybody calls for the death of all alts, like they will trade back up. And there's a reason for tokens to exist. There's a reason for builders to use tokens as part of the way that they, align incentives and trust, and potentially even as a form of ownership in the future. And so I think, your alts will catch a bid, maybe not, your specific shitcoin, whoever's listeing, but like,
I thought you were talking to me, Rob. I feel attacked. I'm gonna let that fly by.
He's like, it's behind me. No.
You're telling me my book is going to catch a bid? Thank you. I'm looking at my wounds here.
No. Your specific coin, I'm sure, if you ever have one, would catch a humongous bid. But no, I think coins will catch a bid again. But I think to the point you said, I'm long-term bullish. Go and build. Like, it is a good time to be here. And don't be so distracted by price. It's easy to do it, but also like by the time that everybody's doing a public company, that means the trade is over, right? By the time that like everybody is talking about stablecoins, that means the trade is over. When it becomes a consensus is not when you make outside returns.
Yeah. Last chapter, I know none of this financial advice. I mean, we could talk about other new stuff, but I actually, on that point, like, you guys have been through and through investing through cycles. You're one of the larger funds. I'd say you don't necessarily invest where the, fair wind investors, if that's a term. What are some of the like the key buckets that you are excited about to deploy capital behind?
Yeah. So I remain excited about the things that I've always been excited about. Like, what do blockchains do, right? Like they send data and value, right? Like that is what they do really well, right? And what is a permissionless, decentralized, trustless system that sends data and value? What does that do well? It does finance. And so I continue to be really excited about the things we're talking about, right? I continue to be excited about payments, and I continue to be excited about stablecoins and DeFi and real world interesting use cases of bringing people on chain to give them those things in a better system with a better user experience than they have before. And so that's what I'm really constructive on. Like, it's not, we continue to look at AI, we continue to look at some of these other verticals, but at the core of what this industry is, and I say this as someone who spent my whole career in fintech, so I'm obviously biased, but the core of what this industry is, it is bringing global internet native financial markets that are better than what we have today to the world and to the masses. And that is what I want to continue to invest in.
Yeah. Yeah. It's almost like, I feel that as an industry, we always like come at it from a defensive position, because look, like people outside in, crypto is still not a relatable piece of technology. It's starting to kind of become more relatable, but objectively speaking, most of the world still understands how the hell this technology is going to fit into their daily lives. It's said differently, AI is so relatable. Why? Because you go to ChatGPT and it's a prompt that like search is so native to people that it doesn't require like new mental processes and habits to form. Crypto is not relatable. The exciting part is, to your point, like I think as an industry, we constantly every cycle need to justify our existence by saying we're going to like do crypto AI and then some sort of like new 0 to 1 primitive. It's like, honestly, go back to the very, very early reasons why you got excited and why this industry exists. It started post global financial crisis to bring more transparency to a system that is really opaque. And I mean, this as well as I do, like, it's not to say that banks don't want to adopt this technology. The only department that keeps growing in these places is back office and compliance. Like, they are very motivated to adopt this. And the best part of this is like, there's a lot of infra that's been built. And the exciting part of this cycle is you can actually start seeing it be integrated into the financial system, integrated by large players like a Nubank, a Revolut, some JP Morgans of the world. And it's not to say that, all of a sudden they woke up and said, oh, okay, great. It's like, no, like there are very clear catalysts that allow them to do this. As a public company, you're not going to do something that can jeopardize your business. So if the commissioner of the SEC is telling you not to do it, well, you're not going to do it, right?
100%.
And it's I think just a reminder to go back to those core primitives. Like I feel that we're in this state of the market where anyone that really understands payments, like people outside of crypto that are now looking in, maybe that altimeter person out there, are now more excited about what crypto can do and the type of transformations that it can deliver to particular businesses in the public markets than crypto natives, because their altcoins are not pumping, and so they're all now bearish, looking for the next meta. And it's like, you don't necessarily need to look for the next meta. It's like stablecoins, financial system, that's going to transform a lot of companies. And if all that settlement and flow comes on chain, protocols are going to crank revenue. And it's more users come on chain, that's going to have, a lot of impact to protocols that have built really good technology. Yeah,
we are at the precipice of like getting what we wanted. The people are using like blockchains for like real economic activity that is not just speculation. It is happening. We talked a little bit about like a little bearishly about these products earlier, but it's undeniable that the trend is, there are going to be a lot more users and mass adoption of doing economic value and bringing economies on chain. Like, this is what we wanted. And yet we've like kid ourselves over time that like we should be buying like random shitcoin for like some sort of protocol that's going to like reinvent the way we think about like some sort of social media that nobody actually wants, right? And then the token doesn't pump, and then we're all upset about it, right? Like, let's just get back to the core of what we wanted, the core principles of, what Satoshi wrote about. And honestly, you and I cut our teeth in this industry really in DeFi. And that was what got us really excited about how that DeFi could change the way financial markets worked. And that continues to be the best use case. And
Totally.
that is what I continue to be excited about alongside everything that goes in with that transfer of value.
100%. I mean, I remember in the early days, this is Bitcoin in 2012, and it was trading at like sub $100. And I was comping it to, what's that, right? It's $100. I think it was like $60, right? 21 million. I'm doing the math here. It was like 1.2 billion. And I was looking at that and I was like, the remittance use case is like, wow, I can move money cross border. I can hedge this out, the price volatility. And then I was comping it to like Western Union. And like Western Union is, hold on, wait, ladies and gentlemen.
What's it, 3 billion?
I was trading like pretty distressed, but back then it was like, I think trading at much higher, but like, it was like a multiple of where Bitcoin was.
Yeah.
And so like, as we sit here today, crypto, including Bitcoin, is a $3.4 trillion. I guess that includes stablecoins, but anyways, Bitcoin's like 2 trillion, and then everything else drops off after. Like Ethereum's like 300 billion. But if you just stop here, if you don't innovate like fully homomorphic encryption and all this other stuff, if you just say, okay, stable coins and then some very specific use cases around that, you could argue and you could still underwrite that this is a venture-like return. If it starts,
Easily.
yeah, and so a lot of that's the point. Like, don't overthink it. Yeah,
No, I mean, if you just use Metcalfe's law and you just think about the value of networks and you think about the amount of users that are going to start to come on chain, the amount of economic activity that is coming on chain, like it is so easy to see how the right smart contract platforms just go massive from here, right? And so I don't know. It feels like we're overthinking it. It feels like people just want that quick win. There's just a lot of, I think, fatigue due to some of the 24/7 market dynamics, et cetera. But I'm so bullish right now about the future of this space. I'm just bullish in the pockets that make sense. And I'm not bullish on like all of this other crap that people talk about on Twitter.
Yeah. As we wrap up the segment, I know how much you like Hyperliquid. I can't wait for our fellow Kenneth Worthington at JP Morgan, who put out this report on Circle. The next report is going to be him comparing Coinbase, who is now launching perps, to Hyperliquid or Uniswap.
I hope so.
I can't wait for these comparisons because, to your point around networks and how networks are vastly more profitable, like you have, an organization on the left, like the table is something to the effect of Coinbase, massive overhead, employees, and footprint, and has to, this cost structure, thousands of employees, and then you have, or even Binance, and you have Hyperliquid, which has, this better than anyone, 12, 15 engineers.
Yeah, I mean, they've I think they're like in the 20s now, but I mean, the amount of that code base that like Jeff Yon wrote himself is honestly the most insane thing that I've ever heard. It's just absolutely crazy. And I mean, I think you might have seen, we talked about this a little bit, but like DEX to SEX volumes as a percentage, the amount that are in DEXs, continues to just go straight through the roof. Like we're going to be at all-time highs in terms of like DEX volumes relative to SEX volumes. People want to trade in really good product that isn't necessarily Coinbase or isn't necessarily Binance or Bybit. They love Hyperliquid. But you're starting to see it not just in Hyperliquid, you're starting to see it in Spot as well. And so it's not just that Hyperliquid is a better product. It's that people are getting more comfortable with being on chain, and it is a better user experience.
Totally. Yeah. And candidly, I mean, people might start interacting on chain without even realizing it, right? At the user aggregation layer, companies that might abstract away, like make crypto invisible. Absolutely. I mean, I remember when I was at ParaFi, like we were very actively trading on chain, and one of our strategies was stablecoin arbitrage. And there came a time where trading stablecoins, like if you wanted to go a pair of like USDT, USDC, it was actually more efficient to do it in Curve than Coinbase. And so, that's like for us, like that moment where I remember we were sitting there and saying, oh, like you start seeing a window where the common criticism that people are not active on chain might totally miss, which is, no, there's actually a lot of efficiency, even oftentimes more liquidity on chain, and then liquidity begets more prices, better price discovery, and that flywheel just gets going. And I think in a best case scenario, we're going to see that for tokenized stocks and private company stocks and bring more price discovery to these markets. And if we do it the right way, whether it's Republic or X stocks or Robinhood, collectively, these experiments are the net positive for the industry. I think we just got to be measured and, doing it the right way and, managing expectations, so to speak.
But there is nothing that crypto Twitter is worse at than managing expectations. And so you're speaking to the choir, but I don't know if you're going to get anybody to listen to you.
No, definitely not. Anyways, Rob, this has been great. Anything else that you want to talk about? I know we're gone a little bit overboard, but I'm curious if there's anything that caught your attention this week.
No, the only thing that caught my attention was just like how excited people were. And but by the way, I will say this. I took a little bit of mea culpa because I went out and I kind of tweeted about how Con was a weird place to hold ECC. But I will tell you, it's beautiful. And everyone showed up.
Yeah.
Now, I don't know if they showed up to the actual events. I mean, they actually did, but they showed up to the beach. And so at least people were in proximity of each other. And that's great.
Yeah.
And so I take it back. Con is a great place. Put the ECC there again. I think it's going to be for like 3-4 years. Yeah,
I mean, it's a fantastic place. It was a bit hot, but I definitely agree with you. It seems like people are having a good time and a lot of side events. We were there at the Selena conference. We overlapped, and there was the RWA conference that you were speaking at as well, and that was very well organized. And then obviously ECC, and so I'm sure there's a bunch of side events that I wasn't graciously invited, but that's okay. Yeah, I don't know. I'm a dinosaur. Any content you've been on the road, planes, any books or movies or a series that we always like to wrap segments with that.
I got to tell you, I have been so consumed with work that I have not watched a new thing. I've been watching like The Office, like replays, and I have not read a new book in like a month. And so I've got nothing.
The Office is the kind of shows you put on, and like if you want to have like a 20-minute or 30-minute like meditation of like not thinking about anything, like that'll do it for you.
Yep, it's great.
That's good. All right, that's good for the week. I'm actually headed to New York next week, so we might do an in-person podcast there. Rob, if you're around, I don't know where else in the world you're going to be talking about stablecoins and with big banks.
We'll be talking about stablecoins with you in New York, I think.
There we go. Maybe we record in-person pods, just hit differently. So maybe we'll just get the keys to Blocktrick's office. We'll let Yano not be there, and we can record in person.
Sorry, Yano, you've been replaced.
Yeah, well, that's what happens. Anyways, guys, Rob, thanks so much for joining us. It's great to have you on, and thanks everyone for listening. And we'll see you here next week. Have a great weekend.
Thanks, Santi.